Hello, everyone. Welcome to our class in Fundamentals in Accountancy, Business, and Management 2. Okay, we will be continuing our lesson on the financial ratio analysis. For today's vlog, we will be answering the exercise problem. Okay, let's try to test our mastery of these financial ratios. Number one, next slide. Moving on, we have here the problem. The exercise problem gives us the asset accounts, the liabilities, the equity, and the income statement accounts. From this financial data, we will be solving our financial ratios. Number one, okay, these are the items that we need to solve. The liquidity ratios, solvency ratios, profitability ratios, operating efficiency ratios. Let's start with the liquidity ratios. When we say liquidity ratios, that means we are measuring the capacity of the company to pay its current liabilities. Okay, how do we solve this? We use the current ratio, the quick ratio, and the working capital. The current ratio is current assets over the current liabilities. And here in this case, we have 1,450,000 current assets divided by your current liabilities of 100,000. So it is 14.5 or 1,450%. So 1,450% ABC company is has the capacity to pay its current liabilities. More so with its quick ratio. With its quick ratio, we deducted some of the other assets. The quick ratio is smaller by 50,000. Why? The current assets is 1,450,000, but the quick assets is 1,400,000 because we only included the assets that are easily turned into cash. So it's smaller than your current assets. It is normally it is normally the asset the cash or and the account receivable divided by your current liabilities of 100,000. So the answer is 14 or 1,400%. So if you will observe the answers from the current ratio to the quick ratio, there is a slight difference. Okay, we are testing how the company can pay its current liabilities. When we also see the working capital, that means current assets minus the current liabilities, it shows to us that there is much more, enough money. We have enough assets to pay our current liabilities. Next, we have the solvency ratio. The solvency ratio here is the capacity of the company to pay its long-term liabilities. Okay, let's see. The debt to equity ratio is total debts over the equity. We measure the the percentage of liabilities. How much do we rely on outside creditors as opposed to our equity account? Okay, so it's 92%, 1,100,000 over 1,200,000. So the debt to equity ratio is 92%. Okay, then we have here the debt ratio of total debts over total assets, which means how much percent of our total assets is financed by creditors or by the total liabilities. So in this case, we have 47.83%. How did we get this? Total liabilities divided by your total assets. So we only rely 47.83 of our assets coming from our liabilities. Then the equity ratio, okay, this also tells us how much, sorry, this also tells us uh, the how much percentage of the total assets do we rely on our equity, or how much of the total assets is financed by our investors. So in this case, we have 1,200,000 divided by 2,300,000. So it is 52%. It is 52% financed by our investors. Now we have the interest coverage ratio. It measures the capacity of the company to pay its interest expense. Okay, so in this case, we have an operating income of 210,000 over the interest expense of 100,000. So that is 2.1, or 210%. So the company has the capacity to pay its current liabilities, no, its interest expense by 210%. Now we have the profitability ratios. When we speak of profitability ratios, it measures the company's ability to generate profit. Okay, so gross profit margin is equal to gross profit divided by the net sales. It gives us 600,000 divided by 1,000,000. It is 60%. Or that means for every peso sale, your 60 centavos will go to your what's this gross profit. Okay, so for every 1 peso sale, 60 centavos goes to your gross profit. But for your net profit margin, we have the net income over the net sales. So here we use the net income. So net income divided by the net sales will give us 21%. That means for every 1 peso income, 21 centavos, for every peso sales, 21 centavos goes to your net income. Okay. Next, then we have the return on equity. This measures the how much percentage does the assets of the company contribute to your income. Okay. So net income of 210,000 divided by your average assets of 2,300,000, that is 9.13%. So um that means that means your assets in the company generates profit, but generates income by 9.13%. Okay, or 9.13. Then we have the return on equity. So for the return on equity, we measure how much income is generated from your equity. So 210,000 divided by 1,200,000 will give us 17.5. So that means your equity contributes 17.5% to every income that you earn. Okay? Next we have, okay, now the operating efficiency ratios. For the operating efficiency ratios, we have the asset turnover. The formula is net sales over the average assets. That means, um, how much income do you generate, or how much sales do you generate from your assets? So in this case, 1,000,000 divided by 2,300,000, that means 0.43 times. For every 1 peso sale, okay, 0.43 centavos was generated by your assets. Okay. So the fixed asset turnover, that is net sales over the average fixed assets. So 1,000,000 divided by the 850,000. So it will give you 1.18 times. So this means that your fixed assets contributes 1.18 times for every peso saved. Okay. Next, the inventory turnover. The inventory turnover is cost of goods sold divided by the average inventory. This shows how fast you can sell your inventories. Okay, how fast do you turn around or do you sell your inventories per year? So in this case, 400,000 cost of goods sold divided by your average inventory, that means 8 times. So that means you sell your inventories 8 times a year. Okay. Next, we have the days in inventory. Days in inventory means the formula is 365 divided by the inventory turnover of 8. So that means 45.63 days or at least 1.5 months. This means that you are your inventory in the business in the company stays at least 45.63 days before you purchase again your next batch of inventories. Okay, accounts receivable turnover, that is net sales over your average accounts receivable. So in this case, this is 1 million divided by 100,000. The answer is 10 times. Okay, accounts receivable turnover means how fast do you collect your receivables. So in this case, you can collect your receivables 10 times a year. Okay, next we have the days in accounts receivable. That is 365 divided by divided by 10, so it gives you 36.5 days. That means your receivables, you collect your receivables every after 1.21 month or at least every month. Next we have, okay, now we're done. Congratulations. Where did we get the answers right? If you get your answers right, wow, you're really doing great. Congratulations, my dear students. And now it's time to say see you again for our next lesson. This is at your service ABM with teacher Jonah. God bless everyone.